Hello there, and a very warm welcome. If you're steering a growing business here in the UK, then you are in exactly the right place. Today, we're going to pull back the curtain on marginal relief for corporation tax. And we're doing this with a little help from our friends at Pro Tax Accountant, who are frankly one of the UK's top accounting firms. They've helped put this guide together to make sure you can get a real grip on your tax bill. So, are you ready? Let's dive right in. Okay, so just imagine this for a second. You've worked incredibly hard all year, and it's paid off. Your company has finally pushed past that £50,000 profit mark. It's a huge milestone, a real cause for celebration, right? But what if I told you that crossing that very line could feel like you're about to run headfirst into a tax wall? That one question is exactly what we're going to unpack today. We've got a really clear plan for you today. First up, we'll dig into why that tax jump can feel so sudden. Then we'll introduce your safety net, a little thing called marginal relief. After that, we'll get into the nitty-gritty of how to actually calculate it. We'll look at the common slip-ups that catch so many people out. And finally, we'll show you how to flip this whole thing on its head and turn tax into a powerful planning tool for your business. Right, let's kick things off with the problem itself. Your business is growing. You're hitting your targets, but that amazing success can very quickly turn into a new kind of headache when you take a closer look at the UK's corporation tax system. So here's the deal in a nutshell for the 2025/26 tax year. If your company's profits are £50,000 or less, you pay what's called the small profits rate, which is 19%. Nice and simple. But the moment you earn even one single pound over that threshold, the main rate is 25%. Now, that looks like a gigantic leap, doesn't it? A real tax cliff. It's no wonder so many business owners get a bit anxious about this. But you see that little question mark there? It's there for a very, very good reason. And that reason, my friends, is marginal relief. Honestly, you should think of it less like a cliff and more like a ramp or a bridge. It's a system designed specifically to smooth out that harsh jump, making sure your tax rate goes up gradually, not all in one go. You can think of it as your financial safety net. So what does that actually mean in plain English? Well, this definition here says it creates a gradual, tapered rate. Basically, as your profits climb from that 50,000 mark up towards a higher limit, your effective tax rate slowly creeps up from 19% towards 25%. It's not a sudden shock to the system. It's a much fairer, much more sensible way to tax growing businesses. This table lays it out perfectly. You've got three key zones for corporation tax. Anything up to 50 grand, you're sitting comfortably at 19%. Go over 250,000 and you're paying a flat 25%, but that band in the middle between those two figures, that is the marginal relief zone. That's where all the magic happens and where your tax bill is calculated carefully to ease you into that higher rate. So let's lock this first number into our brains, £50,000. This is your lower profits limit. Think of it as the ceiling for that comfy 19% tax rate. The second your profits hit £50,001, the rules of the game change, and you step into the world of marginal relief. This number is the first key to the entire puzzle. And here is the second key number you need to know, £250,000. This is the upper profits limit. Once your profits soar past this line, the safety net is removed. At this point, you're paying the full 25% main rate on all of your profits. So the whole system, the whole bridge, operates between these two goalposts, 50,000 and 250,000. Okay, theory is all well and good, but how does this actually play out on your company's tax return? Let's get our hands dirty and walk through the mechanics with a real-world example. And don't worry, I promise we'll keep the maths as simple as possible. Right, this is the official HMRC formula, just simplified a bit. Now, I know it looks a little technical, but let's break it down. You just take the upper limit, which we know is £250,000, you subtract your company's profit from it, and then you multiply that number by the fraction 3/200. Now, the crucial thing to understand is that this formula doesn't calculate your tax, it calculates the amount of relief. Think of it as the discount you get to take off your final bill. Let's make this real. Imagine a creative agency based in London. They've had a fantastic year and made £150,000 in taxable profit. So step one, we figure out what the tax would be at the full 25% rate. That comes to £37,500. Now for step two, we use our fancy formula. So the upper limit of £250,000 minus our profit of £150,000 leaves us with £100,000. We multiply that by 3/200, which gives us our relief amount, £1,500. And finally, the easy bit. We just subtract that relief from the main tax figure. And there we have it. The final corporation tax bill for our London agency is £36,000. It's not the £37,500 they might have feared. That $1,500 difference is real cash that stays right there in the business, ready to be reinvested in growth, staff, you name it. So what's the big takeaway here? It means the company's effective tax rate isn't 19%, and it isn't 25%. It's actually 24%. It's a blended rate, sitting somewhere in between, all thanks to that £1,500 saving. This just perfectly shows how marginal relief creates that smooth, gradual slope we were talking about instead of a terrifying cliff edge. Now, if it was all that straightforward, nobody would ever get it wrong. But that's not all. Here's where a lot of people stumble. There are two major hidden traps that can catch out even the most experienced business owners, and they can lead to some really costly mistakes and unexpected bills from HMRC. This is the first and possibly the most critical question you need to ask yourself. If the answer is yes, then you need to listen very, very closely to the rules on what are called associated companies. This is one of the biggest areas of confusion I see. Okay, this is so important. Remember those £50,000 and £250,000 limits we've been talking about? Well, they get divided by the total number of companies that are associated with you. Just look at this slide. If you have 2 companies under your control, your limits are suddenly sliced in half. Your 19% rate now only applies up to £25,000, and you hit that main rate much, much sooner. And with 4 companies, the benefit is reduced massively. And here is a massive pro tip straight from the team at ProTax Accountant. A mistake they see all the time is people forgetting about dormant companies. You might have registered a company name years ago for a project that never took off. If that company still exists on the Companies House register, even if it's not trading, it still counts. Forgetting to include it in your calculations can lead to a really nasty surprise from HMRC down the road. Now let's move on to the second big trap. This one often catches out brand new businesses in their first year of trading, or any company that decides to change its accounting year end. If your accounting period isn't a full 12 months, the rules change yet again. Yep. Just like with associated companies, the limits are adjusted. It's done on what's called a pro rata basis. So, to keep it simple, if a company has only been trading for 6 months, its lower limit is cut in half to £25,000, and its upper limit drops to £125,000. It's a pretty logical rule when you think about it, but it's so easy to overlook if you're not aware it exists. Okay, so we've covered the what, the how, and the what not to do. But stay with me here, because this next part might just surprise you. This isn't just about dodging mistakes. This is where we learn how to turn tax from a chore into a genuinely strategic business tool. See, when you know exactly where these thresholds are, you can start making much, much smarter decisions as your year-end approaches. For instance, let's say your profit forecast shows you're going to be just a tiny bit over that £250,000 limit. Well, instead of just accepting that higher tax bill, you could decide to bring forward a purchase of that new equipment you've been needing. That investment reduces your profit, and it could potentially pull you back down into the marginal relief band, saving you thousands. It's the same with timing a director's bonus or even deferring an invoice. It's all about having control and being able to forecast with real accuracy. So, if you're going to take anything away from our chat today, let it be these 3 things. First, please remember that marginal relief is your friend. It's a bridge, not a cliff, and it's there to smooth your journey from the 19% to the 25% tax rate. Second, always, always be aware of the 2 big traps, associated companies and short accounting periods. They will reduce your thresholds. And finally, remember that this knowledge is power. It lets you move from just paying your taxes to strategically planning for them. Now, while this guide gives you a really solid foundation, every single business is different. The rules, especially the ones around associated companies, can get seriously complex. For advice that is tailored to your exact situation, your best bet is always to talk to an expert. You can get in touch with the fantastic team at ProTax Accountant directly on WhatsApp or by phone at 07985 689 912. Or you can just send them an email at info@protaxaccountant.co.uk. And for more essential business guides just like this one, make sure you hit subscribe on their YouTube channel. Thanks so much for joining us, and we'll see you in the next one.